Welcome to the Deep Dive. Today we're digging into Marsh McLennan's Q3 2025 results, MMC.
Right. And it's a really interesting one. You had these great earnings, but the market reaction was, well, pretty rough.
Exactly. So our mission today is to unpack that contradiction. Why the stock drop after such a strong beat? And also, what's this big new strategy, Thrive, all about?
It really is a fascinating puzzle. I mean, just looking at the raw numbers for Q3, they definitely beat expectations.
Yeah, adjusted EPS was $1.85. The street was looking for, what, $1.79?
That's right. So a nice positive surprise there, about 3.35%.
And revenue kept pace, too.
Mhm.
Pulled in $6.4 billion against forecasts of around $6.34 billion.
Which is, an 11% jump year over year for consolidated revenue. That's pretty solid growth.
On top of that, adjusted operating income up 13%, and the margin ticked up 30 basis points to 22.7%.
And, hold on that margin point for a second. 30 basis points might not sound huge, but for a company this size globally,
It's significant.
it really is. It shows that their focus on efficiency was already working even before this new Thrive program we're going to talk about. These are objectively very strong results.
Absolutely. Looks good on paper,
Yeah.
but then boom, the stock drops 8.25% in pre-market trading as soon as the news hit.
Yeah, that's a steep fall, not just a little dip.
So why? Why did the market basically ignore the Q3 numbers and react so negatively? What risks are they pricing in?
Well, I think it boils down to a couple of things, really overriding the good Q3 news.
Mhm.
First, there's uncertainty about future growth, particularly organic growth.
Yep.
And second, the pricing pressures they highlighted, especially in commercial insurance. Investors weren't really looking backwards at Q3, they were looking forward.
Right. They saw the headwinds.
Exactly. The continued slide in commercial insurance rates, that hits organic growth potential. And then there was also this drop in fiduciary income, which maybe spooked some people too.
Yeah.
That 8.25% reaction, it tells you the market's worried about future margins getting squeezed from, well, both sides' revenue and that interest income piece.
Okay, so management sees this reaction. They know the market's asking, nice quarter, but what about these headwinds? Which, I guess, brings us straight to their forward guidance and this big strategic answer, Thrive.
That's the setup. Thrive is basically their big move to say, look, we know the external environment is tricky, but we're taking control of our own efficiency and future.
So what's the guidance looking like now?
Well, first off, they're sticking to their guns on the full year 2025 outlook. They still expect to deliver mid-single-digit underlying revenue growth.
And just quickly, underlying that means stripping out things like currency swings and acquisitions, right? Getting to the core business growth.
Precisely. It gives you that cleaner picture of organic performance. And importantly, they're also still targeting their 18th consecutive year of reported margin expansion.
18 years. Wow.
Yeah. And the CEO, John Doyle, sounded pretty confident. He said things like, we like how we're positioned and not pessimistic about growth. That confidence seems to be underpinning this whole Thrive initiative.
Okay, let's talk Thrive. Accelerating growth, improving efficiency. But it comes with a price tag up front, doesn't it?
It does. They're aiming for about $400 million in total savings over 3 years.
Okay.
But to get there, they expect to take around $500 million in charges, mostly restructuring costs, that kind of thing.
$500 billion in charges to get $400 million in savings.
Yeah.
Initially, that sounds like a net negative. Why take that hit?
Yeah, it's a fair question. That $500 million charge is definitely substantial, but the thinking, the management view is that this is an investment.
An investment in future efficiency.
Exactly. Those savings, the $400 million, are expected mostly to flow through to the bottom line annually after the plan is done and continue long past the 3 years. So they're front-loading the pain now, while earnings are decent, to build this more efficient structure for the long haul.
Taking the medicine now for long-term health makes sense. But Thrive isn't just about the financials. There are some pretty big structural changes, too, like the name change.
Yeah, that's probably the most visible piece. The parent company, Marsh McLennan Companies, is simplifying its brand.
To just Marsh.
Just Marsh, effective January 2026. And the stock ticker is changing, too, from MMC to MRSH.
Interesting. What about the individual businesses like Guy Carpenter, Mercer, Oliver Wyman? Are they disappearing?
No, not immediately. They'll keep their current identities for a bit, but the plan is for them to adopt the new Marsh parent brand look and feel starting sometime in 2027 after a transition period.
Is that just a branding exercise, or is there a deeper strategic reason? Does changing the name really matter that much to their big corporate clients?
Well, the company line it's about simplification and unity, making it clearer what they offer across risk, strategy, and people, kind of signaling they're one cohesive unit, not just, a holding company for different firms.
And that cohesion is key to the savings.
Absolutely. Which leads to the operational side. They're creating this new internal unit called Business and Client Services, or BCS.
BCS. Okay, what does that do?
Think of it as the engine room for Thrive's efficiency goals. It's centralizing a lot of the operations and technology functions that were maybe duplicated across the different businesses globally.
Ah, standardizing platforms, centralizing back office stuff like HR, IT.
Exactly. Shared services, consolidating systems. And a big part of this is leveraging their scale in lower cost locations.
Right. The outline mentioned something like 19,000 colleagues in cost-effective centers.
Yeah, over 19,000 people already in those scalable global locations are part of BCS. Centralizing functions lets them shift more of that routine scalable work to these centers much faster. That's a huge lever for hitting that $400 million savings target.
Okay, centralization, optimizing location strategy, and technology, especially AI, must be a massive part of this too.
Oh, absolutely. They're leaning heavily on AI. And this isn't just talk. They've apparently been investing in large language models for a couple of years now and have tools already running at scale.
Like what? Any specific examples?
The big internal one seems to be something called LENAI. It's their own proprietary Gen AI tool for their colleagues.
Okay.
And get this, they said colleagues are using it to handle about 1 million inquiries per week.
1 million a week. That's enormous.
Yeah.
What kind of inquiries? Is this replacing jobs or just automating grunt work?
The company frames it as boosting colleague productivity, handling internal questions, automating low-level tasks, freeing people up for more complex client work, using their massive data sets more effectively.
Makes sense. Are they using AI on the client side too?
Yes. Mercer has rolled out ADA, an AI assistant in their Talent All Access portal for HR clients. And on the risk side, they mentioned Centrisk, which is an AI platform for assessing supply chain risks.
So AI is both an internal efficiency driver and a client service enhancement tool under Thrive.
That seems to be the strategy. Use it everywhere to cut costs and improve the offering.
Okay, so we have Thrive, this big internal push for efficiency and tech integration, but it's happening against that backdrop of market headwinds that worried investors. Let's circle back to those external pressures. The CEO used the word unsustainable about market pricing.
Right. The operating environment is definitely challenging. A big factor is that continued drop in commercial insurance rates. The Marsh index showed rates down 4% again in Q3, same as Q2.
Driven mainly by property insurance.
Yeah, global property rates were down 8% year over year. That really puts pressure on premium growth for insurers and brokers.
Okay, falling rates.
Exactly.
But you also mentioned fiduciary income being a headwind. The source said $29 million down year over year due to lower interest rates. But wait, haven't rates generally been higher lately, not lower?
That's a really good point, and it needs a bit of nuance. We're comparing Q3 2025 to Q3 2024, which might have still captured some peak rate benefits from the previous cycle.
Ah, the year-over-year comparison.
Exactly. Plus, you have different rate dynamics in different global markets and maybe a lag effect on the short-term funds where they earn this interest. So fiduciary income, the interest earned on client money held temporarily, it dropped by $29 million year over year to $109 million in Q3.
And they expect it to fall further.
Yeah, they guided it might be around $85 million in Q4. So it's another area where income is under pressure compared to last year.
So you've got pressure on premium growth from falling property rates and pressure on this other income stream from shifting interest rate dynamics. Bit of a squeeze.
For definite squeeze. And it's not even uniform pressure. While property rates fall, casualty rates are actually increasing. Globally, up 3%.
Yeah.
And U.S. excess casualty, that spiked 16%.
16%. Wow. So the cost of covering liability risk is shooting up while the money coming in from property premiums is shrinking.
That's the core dilemma. The cost of risk is rising, particularly liability, while pricing in other major lines is softening. That's the unsustainable situation the CEO talked about. It forces you to get incredibly efficient internally, hence thrive.
Makes sense. Despite all that pressure, though, the underlying business segments still seem to hold up okay in Q3. Let's look at that underlying growth.
Yeah, they showed resilience. Risk and insurance services overall grew 3% underlying.
Okay.
Within that, Marsh itself was up 4% underlying. Interestingly, international was stronger. EMEA up 5%, Asia Pacific up 6%. U.S. Canada was a bit softer at 3%.
And Guy Carpenter, the reinsurance part.
Also pretty resilient, up 5% underlying, which is decent given what they described as softer conditions in the global reinsurance market right now.
Okay, what about the consulting side? Mercer and Oliver Wyman.
Consulting overall grew 5% underlying. The real standout there was Oliver Wyman.
Oh, yeah. How'd they do?
Up 8% underlying. That's actually their best quarter in about 6 quarters.
8% in consulting is strong, especially now. What drove that? Big projects.
They mentioned some timing benefits helped. Maybe some project revenue landed in Q3 instead of Q4. But it still suggests pretty healthy demand for their high-end strategy work, maybe related to all the restructuring and efficiency drives happening elsewhere. They did signal it might moderate a bit in Q4, though.
Okay. And Mercer?
Mercer grew 3% underlying. Health was strong, up 6%. Wealth was up 3%. But the interesting signal was the career segment.
What happened there?
It was flat year over year.
Flat. Does Mercer career being flat suggest companies are maybe pulling back on big hiring plans or major compensation restructurings, especially in North America?
That seems to be the implication. Management specifically mentioned some softness in project-based work in the U.S. and Canada. When companies get cautious about big organizational changes or talent initiatives, that segment can slow down, sort of wait-and-see mode.
Got it. One last piece, the capital allocation. Even with this big $500 million charge coming for Thrive, are they still returning cash to shareholders?
Oh, yeah. They bought back $400 million worth of stock just in Q3. That brings their total buybacks to $1 billion for the first 9 months of the year.
And M&A, still active.
They said they're sticking to their string of pearls strategy, focusing on smaller strategic acquisitions that fit well culturally and strategically rather than huge disruptive deals.
Okay, so let's try to tie this all together. Marsh McLennan puts up solid Q3 numbers, beats expectations.
Right.
But the market freaks out about forward-looking headwinds like pricing pressure and slowing fiduciary income.
Exactly.
So management responds by doubling down on their guidance and launching Thrive, this massive internal overhaul using centralization, technology like AI, and eventually a unified brand. They're spending $500 million now to save $400 million a year later and build a leaner machine.
That's the narrative. It's a proactive move to control costs and complexity internally, positioning themselves to be more profitable regardless of, or perhaps especially when, the external market turns.
Which leads nicely into our final thought. The CEO explicitly called the current pricing dynamic falling P&C rates, while the underlying cost of risk goes up unsustainable. That strongly implies a correction is coming eventually. Maybe a sharp one where prices harden significantly.
It almost has to eventually.
So the question for you, the listener, is this. How quickly will this newly streamlined AI-powered unified Marsh organization, built through all the effort and cost of Thrive, be able to really capitalize when that insurance pricing cycle inevitably swings back up? Will their internal transformation timing line up perfectly with the market turn? And just how much extra profit leverage will that new, leaner cost structure give them when premiums start rising again? Something to think about as they embark on these next 3 years of change.